Thanks very much, Dimitra. It's a pleasure to be here in Kiev and to participate in this conference sponsored by the NBU and the Polish Bank and the Bank of Canada. And I should say that all statements I make are my own opinions only and not those of the IMF or its executive board. Okay, well, see if I can get this to work. Oh, okay. Here we go. The framework I want to use for this set of remarks is one of two very contradictory views about monetary policy in the open economy. One of these views is that the open economy, provided the exchange rate is flexible, is qualitatively no different from the closed economy. And the one paper I would cite in this tradition is one that Mike Woodford wrote, admittedly before the great financial crisis, in a volume edited by Jordi Gali and Mark Gertler, where he basically shows that, you know, the central bank with an inflation target can meet that target provided the exchange rate is flexible, regardless of what shocks are coming from outside of the economy. The other view, which is diametrically opposed, is one that Hélène Rey has put forth in a number of papers that are pretty well known now on dilemma versus trilemma, which is that small open economies have no monetary autonomy, in fact, regardless of the exchange rate regime, because of the effects of financial inflows driven by a global financial cycle linked mostly to monetary or financial sector developments in bigger countries, notably the United States. I'm going to take a position intermediate, I think, between these two views, because I think they both have some validity. On the global financial cycle, it is clear that if you just look at flows into emerging markets as one of many possible measures, you can see a common cycle in many of the components. And this chart is trying to illustrate that. It breaks up investment flows into emerging markets into FDI, portfolio equity, portfolio debt, and other investment flows, which is mostly banking flows. And what you can see here is while FDI, which is the yellow dashed line, is incredibly stable, these other flows do show a lot of co-movement, and these are actually not the flows themselves, but the estimated portion of the flows that is explained by a global cycle in flows, which comes out of a cross-country panel regression, and this is a paper by Cerruti, Claessens, and Puy, if you want to look up get more details. So there is a financial cycle there, but what does it tell us about the potency of monetary policy and the trilemma of monetary policy? Well, let me first review what we mean by the trilemma. The trilemma of monetary policy in the open economy states that the following three characteristics, which many would regard as desirable characteristics, are not all mutually compatible. A fixed exchange rate, free cross-border capital movements, and monetary autonomy. You know, just to take an example, if you fix the exchange rate, if you allow capital movements, then monetary policy will have to be devoted to fixing the exchange rate. It can't simultaneously target domestic prices or domestic output or some other thing. Conversely, even if you have capital mobility, if you allow the exchange rate to float, then monetary policy can target something else. And I think that is the basic message from the Mike Woodford paper I mentioned. Even with open capital markets, if you have a floating exchange rate, you can devote the exchange rate, the monetary policy tool to a price level path. Now, in the days of the Bretton Woods system, the US indeed occupied a very singular position in the world economy, because with N exchange rates in the world, N currencies in the world, you only had N-1 exchange rates. And so if countries outside the US pegged their exchange rates, you would have a complete system of fixed rates, but that left a degree of freedom, which was the freedom for the US to use monetary policy. Now, technically, there was a link between US monetary policy and the price of gold, but for various reasons that I don't want to get into, that was quite loose and was loosened over time. So the US indeed was exceptional. At the end of the 1960s, and even much earlier than that, people like Milton Friedman, Harry Johnson, argued for a regime of floating exchange rates on the grounds that floating exchange rates would create symmetry. Every country would be able to use its monetary policy to target its inflation rate. And this, they said, would be a much more preferable system to one in which the US inflation rate was determining inflation rate abroad, for example, in countries like Germany and Switzerland, which were very unhappy with the results. What in fact did happen as exchange rates floated in the early 70s, one of the things we learned was that life was much more complicated than Friedman and Johnson had advertised. In fact, very early on in this period, Charles Kindleberger wrote a paper for the Boston Fed called The Case for Fixed Exchange Rates, 1969. It was published in 1970. And he had a famous quip. He said, along with one more instrument, the exchange rate, there is one more target, the exchange rate. And this was even before we started talking about the kind of financial stability concerns that we talk about now all the time, which the governor mentioned in her presentation this morning. So, where are we in this debate about monetary autonomy? Is it there? Is it not there? How should we think about it? Well, I would argue that neither of the quotes that I gave you at the beginning, the first one saying that with floating exchange rates, monetary autonomy is complete, the second one saying even with floating exchange rates, there's no monetary autonomy, is right. The first of these quotations is basically about a world in which there's one target and one instrument. Okay, you want to target inflation, you have monetary policy. And that's the end of the story. That's a very simple story. But it's not the world in which real central banks live. And I think reflecting on that world will give us a better perspective on, the second story about monetary policy today, which is that central banks have no monetary autonomy, because I think that is also an exaggeration. Now, of course, I'm setting up both of these authors kind of as straw people, because I'm trying to make a point, and neither of them would be as definitive as I am being in stating these positions. In particular, I think if you asked Woodford today, he would raise some of the issues that Roch Armenter raised this morning about does the central bank actually have monetary control in a world where the natural real rate of interest may be very low, and so you get into liquidity trap problems. And then can you hit any inflation rate you want? Does the inflation rate have to be sufficiently high in order for you to exercise monetary autonomy? A lot of very interesting new issues have come up in the course of the last few years, and we're trying to discuss many of those at this conference. And will probably make progress but not settle any. But as a general matter, how do we want to think about monetary policy? And I think a great framework is one that Stanley Fischer set out in a paper he wrote several years ago called The Myths of Monetary Policy. I won't read this entire quote. You can do that yourself. But he said that many central bankers he hears talking about, instruments and targets, and having enough instruments to hit their targets. And he points out that for a typical problem that central bankers face, you're never going to have enough instruments. You're always going to have more targets. And so it's not very useful to think about hitting all your targets, because you just won't. How should you think about it? Well, think about a loss function where you try to get close to these targets and where you basically weigh against each other the trade-offs from being distant from all of your targets, not being on target. And again, Rock's paper this morning gave an example of that sort of criterion function for central banks. He actually had one with 3 targets in it. And so that's the perspective I want to think about. Now, once you start looking at things in that manner, what you realize is that you're never going to hit all your targets. And where you end up, where the value of the policymaker's loss function in equilibrium will be, will depend on the trade-off relationships in the economy that the policymaker faces. For example, what is the short-run Phillips curve trade-off between output and employment? Now, how does economic openness matter in this setting? Well, economic openness gives gains from trade, but it can also worsen some of these policy trade-offs when the central bank or the authorities more generally have multiple objectives. And therefore, even if you are optimally exercising whatever monetary autonomy you have, you may not end up as close as you would like to be to your bliss point with respect to the various desired outcomes, whether those be inflation, unemployment, or whatever. There's no doubt, thinking about it in this manner, that with a fixed exchange rate, with an additional constraint on policy, you will never be better off, and what I would argue is that you will actually be worse off. Now, to make that case, one has to argue that there is a benefit from floating exchange rates. There are payoffs to not having to peg. Obviously, you avoid the possibility of currency crises if you're not drawing a line in the sand with respect to your exchange rate. Those can be quite damaging. But it's also true that floating exchange rates play a buffering role that is actually fairly evident in the data. One way to think about the buffering role is to look at a chart like this. These are World Economic Outlook data on forecast revisions for gross domestic product growth between our April WEO forecast and our October WEO forecast. We do this twice a year. And if you plot these revisions for the years between 2011 and 2015 for large emerging market economies against changes in nominal effective exchange rates, you get these graphs. On the left are countries with fairly freely floating rates. On the right are countries with some sort of pegged or heavily managed floating arrangement. And what you see is that, when output surprises on the upside, the currency tends to appreciate, and conversely, when it surprises on the downside, it tends to depreciate. And this is partially due to the fact that currency movements are driven by aggregate demand, partially due to the expected reactions of central banks to these output changes. So, when people say exchange rate movements are completely random and bear no relationship to the economy, think about a picture like this. It is, of course, possible that what this is driven by is a mechanism under which exchange rate depreciations cause output to fall. And while that may occasionally be true in crisis situations, it's not, for the most part, true in this picture over this time period. So, exchange rate adjustments can be very useful, and I would argue have been useful, especially in recent history. If we look at commodity exporters whose terms of trade have fallen, we've seen some fairly large depreciations, which have actually had positive impacts in buffering these economies. So, exchange rate changes are useful, flexibility is useful, and in any case, monetary autonomy is one instrument that we're trying to use to hit many goals, and so we need to evaluate monetary policy in that setting. Sometimes in the closed economy, there is a divine coincidence between stabilizing inflation and stabilizing output. That need not be the case. That's not true in all models. And furthermore, the exchange rate itself, as Kindleberger argued, can be a target of policy. Countries may have sectoral objectives in terms of promoting an export sector which has high learning by doing externalities or productivity externalities. There can be adjustment challenges when exchange rates change rapidly in moving resources between export-oriented and more non-tradable sectors. For countries that have dollarized liabilities, there can be balance sheet spillovers. And so there may be harsher trade-offs for the policymaker in terms of allowing exchange rates to change. And this gives rise to the literature on fear of floating for emerging markets. The idea that central banks might be more prone to limit exchange rate fluctuations. But this doesn't remove the fact that there are benefits from having the additional degree of freedom to allow the exchange rate to move, maybe not as much as under a free float. Okay, so what is the global financial cycle idea about? I think there's a lot to it, and I think it usefully highlights some non-traditional mechanisms of transmission in the modern world of highly integrated financial markets. The traditional monetary mechanism can be viewed as hinging on an interest parity condition of the kind that is up on the screen. I promise there'll only be 2 equations today, so this is, once we do this one, we're halfway through. But this one will be familiar. But the basic idea here is that, if a country is facing looser financial conditions abroad, for example, you're an emerging market, the US cuts interest rates, you'll receive capital inflows. They will tend to make your currency appreciate. If for some reason you don't want it to appreciate and you intervene, you'll be likely to buy foreign exchange that will increase your monetary base. Absent sterilization, that will feed through to financial intermediaries who may be not well equipped to deal with a very large volume of intermediation. And that might cause financial stability problems down the road. So this is sort of a standard story If you go back to the work that Calvo, Liederman, and Reinhardt did in the 90s on the wave of capital inflows that happened in the middle of that decade, you'll see this this story, and this is all very very familiar stuff. But in recent years, we've started to focus on a number of non-standard transmission channels, if you will, which may make the situation even more challenging. For example, I have a whole list here, but think of cross-border bank lending that relaxes quantitative credit constraints and may undermine domestic controls. In terms of monetary control, if there are capital inflows, if more, say, dollar credit becomes available from abroad, you're an emerging market whose currency is not the dollar, one can argue that when you borrow in dollars and swap into domestic currency, with covered interest parity, you will still be paying the interest rate that the central bank sets, and so the central bank has monetary control. But in point of fact, covered interest parity may not hold exactly, depending on what the opportunities for hedging are, and many economies have experienced have experienced carry trades when borrowers choose not to hedge. This has been disruptive in many cases. We notice in the data, and I'll show you some data on this, that direct long-term interest arbitrage across currencies appears to be a very powerful mechanism, which could limit autonomy to some degree. The US dollar plays a special role. It's not the role it played under the Bretton Woods system, but as I'll illustrate on the next slide, there's a lot of financial intermediation in dollars in the global economy among non-US actors. They're not US residents or US nationals, and this gives the US dollar credit conditions a special role. And while domestic currency bond markets have developed in a number of emerging markets, and this is on the whole useful because it reduces the problem of original sin of having to borrow in foreign currencies. These markets can be thin, they can be susceptible to events in the US or other large bond markets. They could conceal off-balance sheet mismatches. So there's a lot of change since the 1990s. Just to illustrate a little bit the role of the dollar, this chart shows that there is substantial cross-border bank lending to emerging markets, and that a key role is actually played by euro area banks, but the dollar is the dominant currency in these transactions, just looking at the far right. So, what the Fed does is going to have an effect on a large range of bank balance sheets, not just U.S. banks, and on emerging markets that are financed in dollars. So it's a rather complex world out there, and the global financial cycle, partly driven by U.S. monetary policy, to my mind, is a real factor for countries to contend with. And the fact is, if there are shocks coming from global asset markets, exchange rates in general are not going to cleanly offset those shocks. The Friedman-Johnson shock, the one they worried about most, was higher inflation abroad than what you desire at home. The US is inflating, Germany doesn't want to inflate at the same rate. Germany should float its exchange rate, an appreciating Deutsche Mark. I assume everyone has heard of the Deutsche Mark. An appreciating Deutsche Mark would offset that US inflation. So think about a portfolio shift toward an emerging markets assets. Even if the central bank lets the exchange rate appreciate without intervening, if there's domestic borrowing in dollars, that's going to strengthen domestic balance sheets and loosen domestic credit conditions. So there you have immediately one possible transmission mechanism, because dollarization, while it may be lower, is not, has not totally disappeared. Even if the current account position doesn't change, so that capital inflows don't change, and there's no intervention, so that all the adjustment is on the private portion of the capital account, there can be offsetting changes in gross positions, which could have implications for activity, for financial stability, for general resilience. And finally, portfolio shifts can feed through to other domestic variables, such as corporate borrowing spreads, which tend to fall when there's high global liquidity, or what we sometimes would call risk-on conditions. If you look at corporate Korean spreads, these fall very sharply during the liquidity boom of the 2000s. So, at some level, these are all hypotheses, and some of them are substantiated by various partial equilibrium models. But I have to admit, there's not a lot of general equilibrium modeling of these phenomena, and this is one area where we need some more research. Okay, well, let me show you a little bit of evidence that I think is suggestive, if not definitive, of how the transmission of monetary policies from large to small economies actually has worked. I want to show you some regression results, and this is the second equation, where what I basically do, following a number of authors, is to regress the change in a country's interest rate on a base country rate and some domestic variables. And you can think of this as being akin to a sort of Taylor rule kind of function. I don't want to interpret this too structurally, because it actually raises pretty deep issues of, what do we mean by monetary independence. But what I just want to illustrate is just, the degree to which policy rates and longer-term rates move independently in practice. If we had complete monetary dependence, if we had no independence of monetary policy, then we would expect beta to equal 1. So imagine a country that rigidly fixes its exchange rate, where there's complete openness of the capital account. Basically, if US short-term rates rose by 25 basis points, the domestic rate would rise by 25 basis points. So what I want to do is, pool a large sample of countries and run this regression as a panel regression, and then look at various nuances, some of which I'll describe to you. A background paper looks at these in greater detail, and I'm just going to go over a couple of highlights now. Well, the first thing you can sort of do is say, well, let's take the US as the base country. The US is usually identified as the driver of global financial conditions. And when you do this regression of short-term rate changes, and here we used very short-term, like 1-month Treasury bill rates. It's not really policy rates. It was very hard to get a sufficiently large sample of comparable policy rates. The coefficient you get for your beta is 0.05, so it's quite far from 1. Now, in point of fact, we sort of broke our sample up between emerging markets and advanced markets, and for emerging markets, the number is actually smaller, even though much of the discussion has been about the powerlessness of emerging market central banks. Now, you might think that there are common drivers of these interest rates, and Unfortunately, in regression number 1, since you're regressing everything on a global factor, which is the U.S. interest rate change, you can't control for this through time effects. But if you recognize that different countries may peg to different bases, for example, Ukraine very well might peg more naturally to the euro than to the US dollar, then you can regress with the different bases and put in a time effect. And indeed, that does raise the coefficient to point, well, sorry, I'm getting ahead of myself. Before you put in the time effect, you can just put in different bases because you may be not capturing the fact that, you may have countries paired with the wrong base currency. That drives up your coefficient. Now, if you have this common time effect, you're probably going to be overestimating the reaction to the US base because there's a missing variable which is positively correlated with the US interest rate. So put in this time effect, it drives your coefficient down to 0.04. The final experiment we do is to not put in a time effect, but to put in the VIX. The VIX is often taken to be a indicator of global risk aversion. So a rise in the VIX would mean risk off. It's also associated with a fall in US interest rates because the US is a safe haven. So that's a variable that's negatively correlated with the change in the dollar interest rate. And when you put that in, you actually do get a positive and significant coefficient. You get a bigger coefficient of 0.24, but still nothing significant on short-term rates. And the last point I'd raise is that looking at the bottom here, one of the things we tested is do any domestic variables enter into the regression? And for the short-term rates, the domestic variables are all highly significant. So the picture that emerges from looking at these short-term rates is that there's not much correlation in the short term between rates. Domestic factors matter. There seems to be, therefore, some exercise of monetary independence at the short end of the curve. What about long-term rates? You can do all of these same experiments, and I'll just point to column 8 here, which is the last column, which is the one that contains the VIX. And you see that all of these coefficients, but particularly the last one, are significant. It's 0.63. Significant at the 1% level. The domestic policy variables tend not to matter. And it's a pretty high correlation. So somehow at the long end of the yield curve, there's a lot more coherence. And this is the direct long-term arbitrage phenomenon I referred to before. So at the short end, the exchange rate regime matters. If you break up into pegs and non-pegs by putting in a dummy variable, the correlations are indeed higher for pegs. You can't really say that there's no monetary independence. Okay. Let me skip over the next slide so that I can this slide is basically something from our World Economic Outlook, and you can find it there, but it's looks at gross capital flows, the share explained by global factors, and what you find is that for floating rates, indeed, global factors do matter less. So this is another way or another metric of the point I made before. Okay, so there is monetary autonomy, and so what is the problem with the global financial cycle? What Alain Ray argues is that the global financial cycle is associated with financial stability problems, and what you need to escape those is either macroprudential instruments or if those cannot be made effective, then capital controls. Now, of course, this is not a particular problem of the open economy necessarily. Even for the closed economy, as I mentioned before, financial stability is an issue. There's a huge debate about the extent to which monetary policy should be shaded to deal with financial stability issues. But you can't use one instrument, monetary policy, and expect to exactly hit your inflation target, your financial stability target. You know, as the governor said this morning, you know, there are at least 3 goals, right? Output, inflation, financial stability, probably more. So even in the closed economy, there are trade-offs, but in the open economy, it's going to be even worse. And in what sense in the open economy is it going to be even worse? And the argument I would make is it's worse because it's inherently harder to do effective macroprudential policies in the open economy. Now, I find it useful to think about this problem in terms of a different trilemma, which Dirk Schoenmaker has highlighted in his work. And it's one that says you can't have all 3 financial stability, open capital markets, and national control over financial supervision and regulation. An extreme version of this, which we've seen recently, has been in the Eurozone crisis, where supervisory capacity was delegated to the national level, but where there were fixed exchange rates within the Eurozone and free movements of capital. And the result has been to gather more supervisory power to the center, to the single supervisory mechanism and to the single resolution board. But these problems are not intrinsic to a common currency area. They actually apply more broadly even to countries which are linked by international financial relationships, but have their own currencies. Empirical work by Cerruti, Klessens, and Levin indicates how macroprudential measures in open economies induce greater cross-border borrowing to offset them. And there are ways you can try to address this, but they probably involve, at least implicitly, some sort of limitation on the free movement of capital. Another sense in which the fixed exchange rate is limiting for financial stability is the difficulty of being a lender of last resort when you're simultaneously fixing an exchange rate. Without going through the details, you know, we always refer to Bagehot when we talk about lender of last resort. That's you know, it's almost a religious exercise to refer to Bagehot and the sacred texts. But reflect that, you know, Bagehot was writing in a world where Britain was on the gold standard. So it had a fixed exchange rate. Monetary policy was being devoted to that goal. But he also wanted the Bank of England to act as a lender of last resort. And the solution, you know, how do you avoid what we now call the twin crisis, is to lend at very high rates. Okay, people say, well, the high rates are about moral hazard. They were at least partially about staying on gold, because if you have a panic and you raise the interest rate and you're lending freely to your banks, you will stabilize the banks. You will also not lose gold or draw in gold. And Henry Thornton, who in his 1802 book actually formulated the lender of last resort theory well before Bagehot did, recognized these 2 conflicting aspects of monetary policy and talked about them. And we saw this trade-off in the Asian crisis. Do you raise interest rates to stabilize the currency and therefore make the situation of your banks worse, or do you keep interest rates low, but then the currency depreciates, making the situation of your banks worse? It's an inescapable trade-off. But there's no doubt that having a flexible exchange rate, at least if you can get rid of dollarization, is going to help you a lot with lender of last resort. So all in all, the floating exchange rate seems to be a winning strategy to me, and to say floating exchange rates don't matter is a huge exaggeration. Okay, so what do I conclude from this discussion? I conclude that the international monetary and financial system is very complex. You know, it's complex because we have interconnected and in many cases opaque, dynamically evolving financial markets. It's complex because we expect policymakers to do many things. But if we would like to get to a more efficient system, it seems like there are a number of elements that we should be aiming for. First of all, flexible exchange rates seem to be essential. I think the Ukraine's experience has illustrated that. So are the best possible domestic macroprudential policies, which we would need in any case just to address the fact that monetary policy can't simultaneously deal with targeting inflation and preserving financial stability. But the financial trilemma indicates that having sound domestic macro-pru policies may not be enough. You may have to supplement them. And in fact, we try to do that through the international coordination that has evolved since the mid-1970s in the work of the Basel Committee, now of the Financial Stability Board. In fact, Basel III contains reciprocity rules that can allow macroprudential to be more effective across borders. Another way to do this is to try to establish domestic regulatory control over large foreign banking organizations, which is something the U.S. has been doing, but at the cost of segmenting the synergies that some of these organizations may create for their business models. Probably, given national sovereignties, full coordination is not going to be a goal that we can attain, and so there is a rule for capital flow measures, administrative measures, which may at times be needed. And so, to my mind, the question being going forward is not if, but how and when. And I think for this purpose, we do need some rules of the road that would allow us to minimize some of the externalities that can arise when countries resort to capital controls. Govern the use of capital controls for attaining competitive advantage over other countries. The OECD Code of Capital Account Liberalization is being revised again to take account of recent changes in international markets. The IMF has evolved an institutional view on capital flow measures, which suggests situations in which they would be legitimately used, and within the organization there's a stock taking of experience with capital flow measures that we're carrying out. Enhanced facilities for international liquidity support are an obvious need. With all that dollar intermediation, it was fortunate that the Fed in the crisis set up swap lines, and there's now a network of swap lines for the major central banks, but that does not extend to emerging markets. Emerging markets have instead accumulated large stocks of reserves, and while these have served them pretty well, including in recent times, gross reserve accumulation can have negative consequences, for example, by imparting a deflationary bias to the global economy. Finally, in terms of national balance sheets, I mentioned lower dollarization as being important, more equity, less debt. This is an evolution we've been seeing, but as I showed on one of the early slides, FDI is very stable. It's a preferred method of foreign finance. Equity inflows of a portfolio nature are still preferable to debt inflows. Debt is probably excessively subsidized and is what leads to debt crises. So, where do I end up? The problems of economic management in the open economy are real. They're particularly real for emerging markets, particularly for small emerging markets. But there is a level of interdependence that we've embraced, which does make all economies susceptible to global shocks. And even in the US in the mid-2000s, Alan Greenspan complained about the conundrum of trying to manage the economy when he found that raising short-term interest rates had a much smaller effect on long-term rates. This is again a symptom of this great coherence in long-term rates that I showed you. Why it happened, was it saving in China? No country is immune, and even though the US has disproportionate power, it too is facing global pressures especially in the current environment. So I'll stop there and leave time for some questions.
Thank you, Maurice. Very good presentation, definitely very insightful and comprehensive. So now we have, I think, around 15, 20 minutes for questions. I would say, on this slide, everything very much perfectly fits Ukraine, especially when you talk about national idiosyncratic issues as a kind of room for capital controls. That's exactly the environment we currently live in. My question is also actually, let me abuse my role as a moderator to ask the first question. My question is actually also regarding this slide. The most of ingredients here is basically what we central bankers are doing. Macro-proof is our policy, monetary policy is also in our hands, and so on. What do you think about where the structural policies are fitting in there? Yeah? Because, the coordination of monetary policy and financial stability, yeah? Where is the role for labor market policies or housing market policies and so on, if you have asset bubbles there and so on? Because, we know, and I think it's discussed all over the world now, that the central banks, they're not kind of the warriors who can resolve all problems. What's your view, how the better fit in structural policies with monetary and macro-proof policies? Thank you.
Yeah, these are incredibly important policies, and they have an impact on how the economy performs generally, but also obviously in terms of more specific areas like financial stability. So the area of housing policy is a great example. We know that at least looking across advanced economies through a long span of history, the main locus of financial crises is the housing market, right? One of the reasons we seem to be so susceptible to bubbles is just that, housing policy, zoning policy, that in some areas you can't build. And so house prices become much more inelastic and much more sensitive to financial conditions. At the same time, those sorts of restrictions have been found to have big costs in terms of GDP, just in terms of potential output. So, from the standpoint of potential output, from the standpoint of stability, these are very important. Now, the central bank can, often intervene in housing markets in particular ways. For example, loan-to-value ratios. I don't know if the NBU has that capacity. Some central banks do. But it may be that the nub of the problem is elsewhere, that it's not financial, it's more structural. And in that case, loan-to-value may not be the right instrument. It may be a second best instrument. It may deter household formation, which may have effects on population growth and long-term potential. So, these are all very complicated problems. In terms of other structural policies, such as labor markets, these have an immediate impact on the trade-offs that the central bank faces, right? If labor markets are very rigid, attempts to, in fact, if you look at the divine coincidence literature, one of the situations in which you don't get this divine coincidence between output and inflation is when real wages are rigid. And so that's just telling you that monetary policy has a tougher task. So to the extent that structural distortions can be eliminated, you're likely to be able to attain higher levels of welfare and lower, more stable inflation at less cost in terms of deviations from full employment.
Thank you. So yeah, we are ready to take the questions. Yeah, please.
Hi, thanks a lot, Maurice, for your talk. As you described, you put in your formula, the relationship between international rates and domestic rates. Yet typically, as far as I know, central banks, under the laws of their countries, have national mandates, national monetary policy, and national financial stability. Yet they're facing external shocks. They have to justify why they're reacting to external shocks under the mandate of national monetary policy and national financial stability. One way of doing it is, of course, through an organization that you represent, International Monetary Fund. Another way of doing it is through swaps lines. But if you look at global borrowing or global capital flows, you'll see that even augmented resources of the fund or the sort of amounts of swaps lines are completely dwarfed by the borrowing amounts. So regions have some areas have decided to set up their sort of regional arrangements to deal with some of that. But even with that, the resources underneath that are not anywhere near on the scale of the capital flows that are moving around the world. Just sort of looking forward, where do you see potential in terms of arrangements for what's been sort of variously described as a global financial safety net? What are the tools? How do you think about that?
Well, it would be great if the IMF could have more resources for that purpose. It's a very tough problem because, in principle, the U.S. could make infinite dollars available to everyone with dollar liabilities on their books. It's not going to do that. If once a major crisis emerges, it might do that for selected countries, but ex ante, it's not about to make that commitment. And if the Fed did move in that direction, Congress would be, on their back. So, the fact remains that the level of resources, given the way global balance sheets have expanded, is not adequate. Countries have responded by accumulating, in some cases, large volumes of reserves, and they've learned how to use these strategically. Again, this is like another sense in which the floating exchange rate helps you. So, for example, Brazil has not tried to peg its exchange rate in the current crisis. If it had, it would have no reserves left. But you can intervene to make foreign currency available to systemic players who need it, who have foreign currency debt. And so in that way you can act as a lender of last resort to domestic financial system to some degree. So self-insurance with reserves is likely to remain important, even though it's a very imperfect instrument in many respects. What we would like in the fund to coordinate better our work with the regional financial arrangements. In some of them we play a central role, but there is sort of a patchwork. It's often countries belong to several arrangements. It's not really efficient in the sense that sometimes in addition to just funds, it would help countries to have some degree of conditionality as well. So, I don't have a good answer to you. I think we can work at marginally along different dimensions. Improving regional swap arrangements and their efficiency, increasing fund resources to some degree. We are discussing the next quota increase, and actually the latest quota reform that the U.S. Congress passed was a huge plus for the fund's ability to mobilize resources. Thinking about a bigger allocation of SDRs, while it doesn't really create reserves, it allows the world's reserve stocks to be deployed more efficiently. These are all ways to help, but we have to recognize that given the exposures that are out there, it's a very challenging world, and so countries can't simply rely on the global financial safety net. They really have to keep their own houses in order to a greater degree than even would have been the case in the past.
Yes, Marek.
Marek Dąbrowski, I would like to come back to your very first slide about this two supposedly contradicting view on autonomy of monetary policy. In my opinion, they are not contradicting, because the question is whether you really can afford full exchange rate flexibility. And because there is a number of, I would say, medium-sized, relatively stable economies which can basically maintain fully flexible exchange rates, stick to domestic monetary policy objectives. But on the other hand, there is several small open economies, sometimes with poor credibility record, and they are, for various reasons, extremely vulnerable to too sharp exchange rate changes for real sector, for financial stability, for political reasons, etc. And here I think is the real question. And when the size of capital flows increase and sometimes changes sharply, like in 2008, for example, this I think is a real dilemma in such situation. So again, I would not see these two views as contradictory.
Well, I think the first view presupposes that there is only one target, which is inflation, and nothing else matters, and that's very unrealistic for most economies. Maybe even for the United States economy, there have been tensions regarding the exchange rate. So, I present the first view as a sort of theoretical straw man, which is out there. It's basically, an assertion of the point that, if you want to control prices, you control money. Now, again, that's a very partial view of the real problems that any economy faces. It also falls afoul of the issues we discussed this morning, that we are puzzled that we can't get inflation to be higher in some of the advanced economies in a number of emerging markets, like Taiwan, for example. But when we get close to a liquidity trap, then these sort of simple sort of ideas break down. And so, that might be another reason why you would doubt the first statement.
Okay. I think we are ready to take a few more questions. Yeah, please.
Again, thank you for a great presentation. I think it makes rather clear that you're a forceful advocate of flexible exchange rate in the international sphere. From that perspective, what's your view on a small economy monetary union? Like, for example, when the Baltic states have recently joined the euro, do you think that would be a wise course of action for such an economy to pursue? Thank you.
Well, you know, a decision like joining the euro is one that, you know, is not a purely, you know, has never been a purely economic decision. I think the decision to set up the euro is not a purely economic decision, and so it's very complicated to say, you know, you should, you shouldn't. There are a number of considerations. I think one does have to trade off what one gains against what one loses. One might gain a great deal politically. One might gain in terms of market integration. If one, you know, has a high degree of domestic wage and price flexibility, one might not lose that much in terms of stabilization. You know, on the other hand, it could be costly if there are a lot of asymmetric shocks. So it's a different cost-benefit analysis for every country. You know, having said that, it's become clear since the crisis that the architecture of the euro certainly had room for improvement as of you know, the beginning of the euro crisis at the end of 2009, and some improvements have been made, but there's certainly areas where more is needed. And you know, of course, membership comes not only with monetary rules, but with fiscal rules and a lot of other constraints. So, and those might be seen as desirable if a country has a domestic political equilibrium in which fiscal discipline is hard to maintain. So, you know, many elements, and it's hard to give a simple answer that applies to every country.
Thank you. Yeah, I think we are ready to last question. Yeah?
Thank you very much for the presentation. My question is about the dollarization and the trade, how the dollarization makes the trade-offs much worse for the countries. And the question is about how do you decrease the dollarization? Because my reading of the literature is that the best predictor of dollarization is the real exchange rate. So you usually see that in the countries where the real exchange rate appreciates, so for some years, then that's how the dollarization goes down. But then financial crisis happens, like in 2008, and then it switches back very quickly. And it looks like the financial crises are going to happen more and more frequently in the future. So then the question comes, how do you really actually fight the dollarization given the circumstances and the trade-off? Thank you very much.
Well, I think in the short term, it's sort of a macro-prudential problem to look at and discourage currency mismatches, you know, throughout the economy. Now, if you're a you know, a central bank or a regulator, you know, you can regulate the banks. It's much harder to regulate firms. Now we worry about corporates with offshore corporates, especially with currency mismatches. You know, I guess I would read the evidence as somewhat different in terms of what causes dollarization, at least domestic dollarization. One key element seems to be just the strength of institutions and the extent to which those allow you to avoid inflation. So there's a very nice paper by my predecessor in my IMF job, Raghu Rajan and Yanis Tokatlidis, on, you know, the causes of dollarization, which relates it to inflation experience and institutional quality. And so in the longer term, these are issues that you can deal with. fundamentally also, the evidence seems to indicate that heavily managing the exchange rate, or in the limit fixing it, seems to promote dollarization. And so that's another reason why flexible exchange rates, to my mind, are preferable. But there are going to be cases when people are, particularly when you have very low U.S. interest rates, people are tempted to do carry trades, and these carry financial stability threats down the road if these are domestic players. And it's hard to know how we can actually discourage those if people are willing to take the risk. All we can really do is try to immunize our financial system as much as possible from the feedback, and that's something that's not easy to do.
Yeah. Thank you, Mr. Obstfeld. Thank you for the audience. I think given our tight schedule, we need to go on. So let me once again thank you, and let's continue with the next section.